Hi everyone, how we doing? Tony did a great job kind of outlining the whole red flag compass and process, right? So what we're gonna be talking about, I'm bad at stats and I always forget kind of the different quadrants, but this is, I think of as step 2. So obviously it's very innate and natural, and we tend to be very good at making prospects aware of what their problems are, right? We know what a good plan looks like. So if we see funds that are bad, we can identify that, right? Fees that are high, it's easy for us to identify that, and we naturally are going to, in a soft way, and not kind of berating them, which can be an art of its own, making prospects aware of what those problems are, right? And now it's our kind of innate instinct to immediately say, oh, this is your problem, and then this is how you fix it, right? We call that jumping the compass, as Tony talked about. So that is just so natural and instinctual, because again, like we know what a good plan looks like, and we know how to make those fixes, right? And present those solutions, and we get confused and frustrated when people don't take our advice, right? Now, what this step is really all about is getting people to commit to fixing the problem before we present those solutions. So part of this is like, we're not spilling our candy in the lobby and telling them what to do, because then they can go and do that with their current advisor or their record keeper, right? But the whole idea of this, and what the Red Flag program tells you, is that deals stall because prospects don't think their problems are big enough. Yeah, I get it, but whatever, like I'll deal with it later, right? So what this idea is all about is making the problems big and kind of pressing on that wound to get people to commit to fixing it, and then we present the solutions, and at that point the deal is kind of won, and that's the easy part, right? So the idea, the main kind of technique here, as Tony mentioned, is quantify the costs, consequences, and risks of the prospect remaining status quo. So again, quantify the costs, consequences, and risks of them not taking action, and that's gonna make the problem big, and then hoorah, you won the plan, right? So we have a few different sales tactics and ideas. Obviously, these really speak our language. The three of us are dealing in the world of funds and investment innovation every day. So those are kind of our tactics and what we frequently use with prospects, and they work. Principal being a prominent record keeper with having a specialty within the DB world. Tom's gonna be approaching that. I would challenge you, not now, but maybe tomorrow when you are having that Bloody Mary, think about what it is you like, what it is you're good at, and how can you be kind of not transforming your sales process, but just thinking about incorporating the step into what you're already doing, and it can be a very slight tweak, all right? So to start, general investments. So here's the RPAG. Does this thing work? Oh, that's the back button. Laser pointers are fun. This is the RPAG scorecard. What I thought I'd do is take like an hour and run through how the RPAG scorecard is better than all of our competitors, line by line, right? Like you guys are heading for the door, really wanting that Bloody Mary now. So obviously, presenting this to a prospect is just not gonna work. They're gonna fall asleep, it's confusing, it's too detailed. We could do it, and we know there's a lot of firepower behind it, but it's just not that effective, right? So there's different ways that, and I'm gonna go into a little bit of benefits communicator mode here instead of change navigator, but there is one aspect of our scorecard that's really easy to differentiate if you want kind of a microcosm for it. So if you were to look at these two funds here, laser pointer, large cap value CIT with Putnam, ABC company. Looking at the returns, which one would you want? You got ABC outperforming over basically every time period. Probably that one, right? That is the challenge of looking at point in time performance, and most systems use point in time peer group rankings. So in other words, they look at this and the peer rank that's shown for ABC is gonna be way better. As you likely know, the way the RPAG scorecard system works for our peer ranks is we use a median of rolling rankings. Now that is a confusing concept, but a picture's worth 1,000 words. And a lot of this is frankly just about giving an illustration to a prospect that they can look at that helps you explain it, right? It's a lot better than aforementioned chart. So this is a direct screenshot from the asset class review. The fund in green is ABC, orange is Putnam. So as you can see, each of those is basically a point in time 5-year peer rank. You see ABC is higher up because the 5-year number is higher, right? Now what the challenge is with point in time rankings is it doesn't really deal with consistency. So that's what doing our method does is it gives you a better indicator of central tendency. In other words, it just emphasizes consistency, which is so important in our world. So that's how you could explain it to a prospect. Our system emphasizes consistency that limits turnover at the plan level, dealing with administrative notices, right? And it limits participant kind of trading and bailing out during drawdowns, et cetera. So the way this really works, the number you see for our peer ranks is you throw out the lowest 5 observations, you throw out the highest 5 observations of each of these kind of rolling 5-year ranks, and that one in the middle, that median, is the one that's on the scorecard. So if you didn't know that, or you didn't know why our peer ranks differ from like a Morningstar system, that is one way. Now you know. So this really removes outliers. You can see the majority of the performance for ABC was driven by one quarter from bottom half of the peer group up into the top 5th percentile, right? It's really not gonna make that big of an impact on the peer ranks for our system. So thinking of, this is one illustration now, taking kind of the red flag concept into account. Ironically, so we did this 2 years ago. Some of you may remember. You're using old slides, guys, get with it. But it is cool to fast forward 2 years. We're looking at 1231 numbers. Look at what happened with Putnam in 2021, outperforming by 9%, and then about 6% in 2022. So again, taking kind of a nice illustration and then implementing this approach of quantifying the cost of remaining with an inferior scorecard system. So another technique here is with the CITs. Now, the first thing that I'll say is we've heard it throughout the last 2 days, refer to the CITs as the CITs. I would encourage you, especially with prospects, but clients too, think about them or position them as exclusive share classes or relationship pricing. Why? You say CITs to prospects, you guys have probably done this to yourselves, as I have many times. They're like, what is that? And then what do you have to do? You have to like circle back, do this whole history lesson. Well, they were invented in the 1920s. They've been daily valued since 2000. They've had tickers for 5 years, and all of a sudden you're back to that table, people are asleep, right? And you're really missing the whole point of this, which is if they hire you, you give them lower pricing that no one else has access to. Thomas. So that is, again, the exclusive share classes relationship pricing that inherently conveys they get it, right? They hire you, they get those lower cost funds. This is, again, one area where it's tough to not be a benefits communicator. And before you yell at me, Tony, or take me off stage, the one reason why I kind of do take that approach and I'm a little bit more comfortable with it in this specific case is because these are exclusive, right? So think about like presenting a 5 basis point savings on for a record keeper. Everyone has those deals, right? Everyone has access to the same funds. With this, you can be more deliberate. They can't get this without you. And the fact that it is exclusive, I do kind of jump the compass sometimes and start talking about how great these are in the right way.
You're not benefit communicating in this one. You're actually pinpointing and calculating the size of the problem.
Yep.
You just happen to have a whole lot of data to do it.
Love it. Thank you. CCR, sorry, not the band. Cost, consequences, and risks. Yeah. So the idea yes, thank you, Doug, yeah. The idea behind this is, okay, yeah, so you can be a benefits communicator, but let's take it back to red flag, right? This is called our cost analysis or CIT mapping report that our team can run for you for any plan. And the idea is you put in front of, you're telling them about how great this concept is. What does it actually mean to them? So you put this in front of them. This is their current lineup on the left-hand side. This is a proposed lineup utilizing this approach. And in the end, you can barely see it, but there is an annual savings amount, or you can think about that as quantifying cost. That's the additional amount they're paying if they don't hire you. Below that is the 5-year number. So another way for you to press on the wound, you can make that a 10-year number, right? So you're making the problem bigger. This is, by the way, this is $4,500 of savings year one, $25,000 over 5 years. This is a $5 million plan, right? So think about if you're targeting a $50 million plan, we're talking about $250,000 of savings or additional cost that they are incurring if they don't hire you and have access to these types of solutions, right? And then the last thing is approaching this from the liability angle. Again, quantifying risks. All of these are different lawsuits for plans or rulings. The language is just so cut and dry. Take Estee Lauder, a clear indication of defendant's lack of a prudent process was their failure to identify and select available lower cost CITs. You see it time and time again through all these. And how about this in terms of quantifying? Anthem, $24 million settlement, and it's basically the same thing advisors should consider CITs. So look, not every one of our plans is $2 billion and like low-hanging fruit for litigation. But this is a quantifiable number, and we know those are going down and down market. And realistically, just from an optimizing outcome standpoint, those small and mid-market plans want to follow the big dogs. So hopefully some of this helps. Okay, now staying within the world of investments, but more focusing on investment design, menu design, and participant behavior, Jonathan Coombs is going to take over for us.
Thanks, Matt. Good to be back with you again this morning, everyone. When it comes to quantifying the problem, the lineup design is absolutely ripe with opportunities for us to be able to quantify that. And you think historically, over the past really several decades, we've been hyper-focused, as we should be, on the savings crisis, right? People were not saving enough, and you can't invest your way out of a savings problem. Well, the good news is we're seeing positive change. People are saving more. Things like auto features, auto enroll, auto escalate, robust financial wellness programs, better access to participant education devices. All of this is actually moving the needle. In fact, even earlier this week, my wife, who is lovely and has so many talents, but retirement savings is not high on that priority list, was scrolling through Instagram, sees this image of, a cup of coffee a day put into your retirement account, what that would look like in retirement. She actually proactively at dinner brings up to me, what does my retirement account look like? What am I saving right now? I about fell off the chair. So it's come in positive change in a lot of unexpected ways, right? So that's great. But that's just refocused that spotlight on a problem that has long existed and still persists to this day, which is getting participants to invest the right way. So let's dive in here. Here, we're going to basically quantify the value of professional management versus doing it yourself. And I think, again, this is not going to come as news to anyone, but focus on the three highlighted bars. What we're looking at is the average annualized return of various asset classes and solutions over the past 20 years. So not a small time horizon, right? That highest bar you can see, 9.5%, that is the S&P 500. That next bar down, 7.4% return, that is the average annualized return of a 60-40 fund, which is just serving as a proxy for a professionally managed solution like a target date fund. And then look at that lowest bar. 3.6% is the average annualized return of a do-it-yourself investor. Now again, is anybody in this room surprised the professionals tend to make better decisions than the average do-it-yourself investor? Of course not. That's a difference of almost 4% between the professionals and the do-it-yourself investors. And yet, how much time do we spend trying to get a 5 basis point record-keeping discount? How much energy do we put into that? A lot, right? 5 basis points, cool, that's great. But what does that mean to a participant? Let's keep this in really simple math. You got a $100,000 retirement account balance. That 5 basis points was $50. You just saved that participant $50. Well, if you could give them an additional 4% return, that's $4,000 that's going to be compounded over their entire investing journey. How much time are we spending on that, right? So I think it's obvious and clear, that the professionals do it better. It's easy to quantify, but how are we spending our time to communicate how big of a problem this is to a plan sponsor? So let's now look at the applicability of this problem that's very, again, easy to see how problematic it is. Well, who remembers the breakdown of retirement plan assets currently invested in a target date fund? Anybody remember from yesterday? 38%. That is where the assets are in target date funds today. And if you were to look at any plan, it's very easy to get the access to the data. Okay, what do they have in target date funds versus the core menu? This is a very easy way to quantify, okay, we see the results. We know target date funds do a better job, they're easier, and yet look at your plan. And if it's anything like the national average, if they've got 62% of their participants doing it themselves, that is a huge problem. Now, I would argue you could actually take this one step further and just, instead of just what are the assets in the target date funds versus do-it-yourself investors, I would argue that anybody who's invested in a target date fund and any other combination of the core menu should really be on that right-hand side, right? Because that is a participant who has acknowledged the target date fund is not personalized enough for their needs, so they're gonna take on that role and try and customize the target date fund by mixing it with the core menu. So that would suggest that problem is likely going to be even bigger. So again, now, I'm not trying to jump the quadrant again, Tony, give me a second here. it's always good to be aware of what the solution you're working towards is, and obviously re-enrollment is what we're looking at here as a very great solution to be able to solve for it. But it also brings up another challenge, right, which is something, again, we spoke to a little bit yesterday, which is that challenge of, we know target date fund assets have become somewhat stagnant at 38%, even though the majority of new contributions are going into them, which suggests that participants are somewhat rejecting target date funds in some ways. We know 60% of target date fund investors leave target date funds within 10 years of investing in them, which completely defeats the purpose of a target date fund. Why is that? We think that the industry may have swung the pendulum a little too far in favor of age-based diversification as opposed to risk-based diversification, which arguably, risk-based diversification is a little more intuitive for a participant to understand, right? You go up to a salsa bar, see it mild, medium, or hot, easy to know what you're getting into. You see conservative, moderate, or aggressive, you know what you're getting into. So this would suggest a more personalized solution might help offset some of the most damaging participant behavior, because we know target date fund investors in particular are very reactionary and unfortunately see a lot of attrition. So I'll get off my soapbox there. Let's look at the next area that is very, very simple to look at, and yet, can be easy to kind of overlook, which is, we talk about how difficult the process is to be a do-it-yourself investor. Well, take any lineup, and this lineup here, by the way, is like a gold standard lineup. We would be thrilled to see a menu like this that follows efficient menu design. There's no redundancy in the asset classes, and yet 12 core menu options, that's 12 decisions to make. And then you've got to decide how much to allocate to each one, another 12 decisions. So right out the gates, we're expecting that participant to be able to make those 24 decisions and then review those decisions every single year on an ongoing basis. Now, to drive this home, if we were to go around the room and ask everybody, industry experts, to put in what is the appropriate allocation to each of these funds, I would guess we're not going to get the same answer across the board. And we're the professionals. And so when we get pushback from plan sponsors on things like a re-enrollment being such a bad thing or trying to drive better behavior, remember, the plan sponsor, the fiduciary to the plan, is expected to make decisions at a level of a prudent expert. That's a very different level than what's expected of the participant. So very easy way for us to be able to quantify the challenge here. Look at the number of core menu options, multiply it by 2, and then ask that plan sponsor if they expect their participants to be able to do this accurately, ongoing year after year after year. And obviously, I'm not going to even say it, but on the right-hand side, somebody wanted to jump the quadrant. And then finally, quantifying suitability of appropriateness. This is another one that's actually very easy to get the access to this data. Most record keepers have some type of partnership with Morningstar at this point, and that partnership has allowed them to be able to run these reports that can show you the optimal allocation for a given participant based on age. So you can literally see for a plan, all right, how many of your participants fall into that optimal equity exposure who have chosen to do it themselves. And again, if you look at the bottom line there, this is just taking an overall average, and 19% is the average of who is getting it right, whereas 61% are below that optimal equity exposure and 20% are above it. But if you dig into the various age categories, you can see how this can be an even bigger problem than just looking at the average, right? That top bar is participants who are 30 years or younger. So participants who should be maximizing their growth potential, 84% are under-allocated to growth assets. 84%. Go down to those participants 60 and above. You can see 29% are where they need to be, but 34% are over-risked based off where they should be when they're nearing retirement, most susceptible to volatility in the marketplace. So again, another really easy way to quantify how big of a problem this is, to be able to inspire plan sponsors to take positive change when you're presenting those solutions, again, in the next quadrant. So with that, pass it over to Kellen.
Thanks, Jonathan. You're right on time. And I'd stand up, but I'm afraid my pants are a little too tight to get back down on this stool, so I'm going to stay sitting for a while. So Megan and Ellie did a really good job talking about identifying and making plan sponsors aware of some of the issues with target date funds. So I'm going to handle step 2 on how we quantify how big that problem is. And I'll be honest, a lot of folks think when they have their target date fund, hey, performance is good, fees are in line. It's not really a big problem. So it really is on us to make sure they understand how important it is, and then again, quantify how large it is, because as Tony mentioned, they're not gonna wanna solve this problem unless they realize it's something that is really pressing and they need to handle now. So a couple tricks to help do that, right? We're talking about Glidepath suitability risk, participant misfit risk, and then underlying fund risk. So first up, Glidepath suitability risk, right? This is the risk that the glide path that they have does not match their plan demographics, all right? So we're not talking about performance, we're not talking about fees. And again, you can actually quantify really easily, like, hey, I can get you in a lower cost target date fund, here are the cost savings, right? We talked about doing that with the CITs, but unless you're using a CIT that's unique to what you're offering, you're not doing anything any other advisor can't come in and replicate, right? Performance, again, it's fairly easy to cherry pick a target date fund that outperforms the one that they're using today over any given time period. But again, you're leaving yourself susceptible then to another advisor coming in and doing the same exact thing, right? So those aren't really sustainable, unique, differentiating approaches. Glide path suitability risk, in my experience, has been a game changer in terms of changing the conversation and focusing on something that, quite frankly, not any other advisor or most other advisors aren't going to be focusing on, and probably something that the plan sponsor hasn't even heard of, right? And that's a problem right off the bat, because if they haven't heard of it, right, that means they haven't read that DOL tip sheet, which has been around for 10 years now. So they're starting to uncover how big of a problem this really is. So how do you quantify it? So we have an entire fit analysis process. Hopefully you've gone through that for current clients. In a prospect setting, the entire fit analysis is probably a little bit too much, a little bit too time consuming. So you can sort of do a back of the napkin version of it. And what we look at or what we focus on is savings rates, right? Because at the end of the day, savings rates is going to be the primary factor to determine a participant's funded status, which is the primary indicator of how much risk they need to be taking in their glide path. So in this case, you can look at average savings rates across a plan, as well as looking at the plan design, right? What's their match? What's their profit sharing? So in this case, we have an average contribution rate from participants of 7%. The employer has a safe harbor match, 100% up to 4%. They also have a non-elective profit sharing contribution of 3%. That means as a base case, average savings rate, participants are putting away 14% of salary, right? As Megan quizzed us earlier, higher savings rates means higher funded statuses, means less need to take risk as you approach retirement. So a more conservative glide path in this case would be the best fit, right? If the plan you're prospecting has a more aggressive target date fund, you've just identified a problem, right? And you've quantified using savings rates that there's a mismatch. So now your option or your goal is to identify how big that problem is, right? So a couple ways to do that. The first way is looking at returns for different risk level target date funds in different market environments. So obviously, the mismatch we've identified here is they're using an aggressive target date fund, but should be using something conservative. Obviously, if the case were opposite, you'd be looking at a different time period here. But you can identify the different types of return profiles for different risk level target date funds during market drawdowns like we are here in the financial crisis. So aggressive target date funds have a drawdown of 36% compared to conservative at 18%. So literally double the downside risk, right? So now you're quantifying for them how big of an issue this is to expose their participants to unnecessary risk, right? If they needed that aggressive approach because they were behind saving for retirement, that's one thing. But we've identified that they don't need to take on that risk, right? And now you're exposing your participants to this type of downside when they don't need it. And then you can take that one step further and actually put account balances behind it. So on the left-hand side of this chart, we actually have a model to model out, the average participant in this plan. with a starting balance of $10,000, age of 30, starting salary of 60K, right? Again, all this is customizable. You have the ability to customize this. We have these slides built out that you can plug in these numbers. And the savings rate at 14%, again, this is specific to this plan. Over time, that participant is projected to have an income replacement ratio of 110% by the time they retire. Again, that's why they don't need to take on that level of risk, right? But if they were, right, if they were unknowingly in a more aggressive target date fund, that $2.3 million account balance that they've built up over time, if they lose that 36%, right, that's $835,000 that they just lost, right? I mean, this is not a unrealistic example, right? All this did happen during that financial crisis. It happened again in 2020 with the COVID drawdown, right? Not quite as dramatic, but pretty close. Participants that were retiring in those specific time periods actually experienced losses like this that changed their retirement outlook. So, as you go through this, the CFO, the head of HR, the CEO, guess what they're doing? They're imagining a participant in their mind that went through a situation like this and all of a sudden becomes pretty personal, and that's where you start to make some real progress. And then you can take it even one step further if you want and talk about the additional workforce costs that delayed retirement can actually have on the company, right? That participant that loses $800K probably isn't gonna retire this year. They probably have to delay a year, 2 years, whatever the case may be. Obviously, that makes a big impact to the company's bottom line in terms of wage expense, healthcare expense, workers' comp, et cetera. So you look at this, the average cost of delayed retirement, $300,000 a year. Again, you can make that even bigger by multiplying that over a multi-year period. 5 years, $1.6 million in delayed retirement costs. So that's Glidepath suitability risk. Again, pretty easy to identify and quantify. Not every plan is gonna have it, right? You may run across a plan where, hey, whether by luck or because they actually went through their prudent process, they're in a target date fund that fits their average participant base. That's great. So you can move on then to participant misfit risk. As Megan mentioned, in the absence of a more customizable or personalized target date fund solution, you're almost guaranteed to have misfit risk because the likelihood of one glide path being a good fit for every single individual in the plan is almost non-existent, right? Unless it's a really small plan with a very homogeneous participant base. So in this example, this is kind of how you can do it more top level where you say, okay, that average participant is saving 14%. Well, remember, they had a non-elective contribution of 3%. So there's probably a segment of participants that aren't contributing at all. So they're not getting the match, but all they're getting is that 3% not elective. So using that same modeling, that participant that's only contributing 3% of salary their entire career, their income replacement ratio is only projected to be 29%, right? Well, that's not gonna get the job done. So they need that more aggressive target date fund to help make up for that gap. So this is a really easy way to say, hey, you're solving for your average participant with that more conservative glide path, but you're unknowingly leaving this other segment completely in the wind without any sort of good solution. Another way to do this is by using our savings rate misfit risk calculator. So if you can get the data of like individual savings rates for participants in the plan, you can create this histogram, or we can do it. And you can actually quantify the value added by improving the glide path suitability and misfit risk. Morningstar put out a study that said getting a participant into a more personalized allocation is worth 12.5 basis points. So again, you can use that with the amount of assets that are in the target date fund and the percent that are exposed to misfit risk and quantify, in this case, hey, I can add 6 basis points of added value or 11 basis points of added value by using a more personalized target date fund that eliminates misfit risk. And then the last slide here, also really interesting, depending on the market, quantifying the potential impact of lost time investing, right? Jonathan mentioned participant behavior and how participants tend to panic out of the target date fund. That problem is exponentially bigger when participants aren't in the right target date fund, right? So they're in an aggressive target date fund that they don't know they're in an aggressive target date fund, so they panic. And you can quantify for them, hey, if they're out of the market for a year, 3 years, 5 years, right, because they're in cash instead, what does that mean to their average account balance? And it has a huge impact on their ability to grow their account balance over time. So these are just some examples on how you can quantify that. Again, make it a big problem. At the end of that, if target date funds weren't an issue to begin with, hopefully they realize how important it is and it becomes a priority for them. So with that, I'm going to hand it over to Tom to speak about defined benefit plans.
Thank you. Oh, please.
Really well there. What was done there too is the problem was phrased two ways, and it was quantified two ways. Once for the plan participant, but also for the plan sponsor. And you've got two audiences every time we're there, and everybody cares about their plan participants, but they come and go. The sponsor themselves, when they see those numbers on what this is going to cost them, it changes the dynamic and it changes your conversation. And now you've created a problem on two levels that they need to really consider solving, and it creates that much more urgency in terms of wanting to talk to you about what the solution is going to look like, which is obviously something really smart that you're going to sell them that's going to just do great things. So thank you, Tom, for letting me step in there.
You're welcome. Thank you. And thanks for letting me be up here. If they're the boy band, I must be the agent. Because we're talking about misfits. I'm the misfit toy up here. That's for sure. I was feeling good about myself this morning until I got up here with these guys. But thank you for allowing me to be up here. So we're talking about identifying problems and solving for problems. This is a really busy slide. Let's just talk through it. And we're pivoting to defined benefit plans. And I know when that comes up, and we talk about it a lot at Principal. I know our competitors talk about it a lot. If you're talking to a CFO and you want to get their attention, most CFOs cannot stand uncertainty. They cannot stand a contingent liability on their balance sheet that they can't control that goes up and down. Now, the good news, one thing that I will refer to this chart on, when interest rates go up, that helps the funding ratio for a defined benefit plan. The other thing is about 2/3 of DB plans, defined benefit plans, are unfunded. I've had a lot of conversations with advisors over the years, and I get it, it's understandable. Well, that's frozen plan. That's the one you want to go after. Again, that CFO may or may not even be a participant. And if he or she is not a participant in that DB plan, they hate it even more. So here is, and there's some really great prospecting that I was listening to, and it's really amazing, and all that works, and it's all about being consistent. It's a daily process, just like everything else. With the DB conversation, it's harder to get their attention at times. However, if you can get that CFO's attention in this marketplace, the good news is interest rates had gone up, so I'll make up some numbers. Their funding liability, is in better shape. So I'll make up some numbers. Maybe the defined benefit plan was at 80%. Now with increased interest rates, maybe it's at 90%. When you have a hard frozen or a soft frozen DB plan that's out there, the company, wants to get rid of that. The CFO in particular wants that off his or her balance sheet. Again, they can't quantify it. Excuse me, we're going to report the valuation on a quarterly basis, and that helps. Back in the day when the market was tanking and interest rates were going down, and it's an annual conversation, and that CFO realizes that liability just went up by 50%, and that's not a revenue-generating expense. That's awful. It's a frozen benefit that they're trying to get rid of. So with that said, in this environment, now, and talk to your investment team up here, you got CFAs, super bright people. Now is the time to lock in those gains. So what happens in these times, especially in frozen plans, the goal is to get that plan to a fully funded status so they can get rid of it. And number one, you're probably thinking, well, then I'm fired. Not necessarily. One, that's going to take a little bit of time. Two, you're putting that client, specifically that CFO many times, on a plan, a process to get to that fully funded status. You will be their hero, I assure you. The hard part is getting their attention. I get that. I'm here, it's easy for me to say. That's the hard part. If you can get their attention and have that conversation, hey, interest rates have gone up. And we can do research, your team can do research on what that plan approximately is funded at, the funded status. Now's the time to lock in those gains with some LDI, some bond strategies. Because what happens is they will never get to fully funded status. You could look at the CFO with sincerity, with he or she, and say, your plan, and most plans are 60-40. Okay, that's fine. They just stay 60-40. And then the investments in between that mix might move around, that's fine. You'll never get to fully funded status, you will never get rid of that plan. It will always be on your balance sheet. And when interest rates decline, at some point they will, maybe not in my lifetime, I don't know, but they will, it will happen. Then they're gonna go from 90 to 80, or 90 to 85. Lock in those gains with LDI every time. Take the money off the table, lock it in. Here's the asset allocation strategy. Here are the LDI strategies that your team can recommend. Now you've got a game plan. Now you can quantify that path to success. Now you can solve that problem. I know it seems kind of dull, but if you're talking about that type of thing that can really help a company, and for a smaller company that might have a weaker balance sheet or might be struggling from a cash flow perspective, and again, maybe that CFO is not even in the darn plan, they like it less. Even if they're in the plan, it's not like they're gonna lose their benefit. Just new hires aren't entering in. So just really quickly, soft frozen plans, the existing participants are still getting new money, but no new participants. Hard frozen, no contributions going in. Let's get rid of this thing. But the frozen plans are really the one that you wanna focus on. The other part of it is from a sales perspective, and I'm deviating from this just a bit, is, and they're great firms, but a lot of times you might have, like the Millimans or the Bucks or some of like the, I don't know, the higher profile actuaries, if you will, great firms that might be on a $20 million DB plan. Their fees are gonna be 3-4 times higher. And I get that, I respect it. It's really not a client that they want. But if the client's willing to pay the fee, they'll hang around. So you might even be able to get a new record keeper that can actually reduce those fees. So number one, you've got a plan to get to fully funded status. That's the most important thing. Or keep it where it is. And number two, if you benchmark it out, now maybe you're saving them costs. Number three, once you get them to fully funded status, now all those other costs go away. The PBGC premiums, which go up every year, the administrative costs paying people like us, the actuaries, all that. And again, you're the advisor. And then four, now there's wealth management opportunities that are rolling out. And that's another conversation. And then if my counting's right, then five, you're gonna be their hero and you'll most likely get the 401k plan. And then if you're talking about other things than 401k only or 403b only, a lot of not-for-profits have pension plans. Now maybe there's a non-qualified deferred compensation opportunity. There's different things out there. But back to this strategy, having a plan, and I don't know if that helps with the DOL, with the fiduciary responsibilities. I would think it would. Now we have a plan to get to fully funded status and then to terminate this thing and pay out the benefits. Otherwise, you don't have a plan. And it'll just go on forever. So I'm just gonna, again, stay high level. It's just talking about interest rates, where they are. Quite frankly, I really don't wanna dwell on this slide too much. I wanna stick with the process. So interest rates have gone up, so funding status is better, right? So this is a good time. You might get some pushback. Hey, we're in better shape now. Okay, great. Well, you need to lock in those gains. And quite frankly, if you don't lock in those gains, at some point, you're just gonna revert to your old status. Now is the time, and again, usually it's LDI, liability-driven investments, that are driving locking in those gains, and then continue to have some return-seeking investments for the remainder of that funded status. So the clock's winding down on me, but I just want to make sure if there's anything that you recall, please, out of this conversation of my portion, the CFOs, frozen DBs, want that off their balance sheet. And they want that expense off their P&L. And you can help them get there with just some basic conversation and solving that problem. And at that point, it's really a beautiful thing. And it's quantifiable. It's not, well, you're going to get better service from me, or we can take it out to bid. That's not quantifiable. That's qualitative. This is real. And if you can get their attention and get them, the CFOs, listening to you, you have a strategy that will be very beneficial to that client. And I would imagine they'd be very appreciative of it. So any questions on that? Or Matt, I'll turn it back to you. But
Yeah, no, thank you, Tom. The insights are great, and it's good to get a non-investment perspective and shake it up a bit. But as you can all tell, we're all very passionate about each of these topics and are really dedicated to them and have a ton of resources. What you're seeing, what we're clicking through is just a fraction of how we can support you. So if every prospect situation is unique, and really you being the master and having such a good knowledge of the whole industry and all of these kind of different tactics is valuable, you can pinpoint what does apply to a prospect. And if and when any of you find any of those tactics and we can be of service, please reach out to us, and we're happy to kind of do more custom proposals. So I'll close it with that. Thank you all so much for your time.